Okay, everyone, the last part of the work here for this class. After that, it's going to be just a bunch of examples. I want to talk a little bit about the capital cost allowance. The idea here is when you invest money in a project, when you start a capital budgeting project, most of that expense is not, you can't expense it right away the same year as amortization on your income statement. Right? We would like to expense most of it as early as possible in the income statement because it creates a tax shield. Okay, we can't do that. There are regulations on which rate we can amortize a different asset class. I put a table here that you can see that talks about the different asset class and at which rate you can amortize these asset class: 4%, 5%, 10%. We don't care, right? When we make financial decision like that, we don't care about the accounting cash flows, but we do care about accounting cash flows when they generate real cash flows. And this amortization does generate a real cash flow. What cash flow does it generate? It generates a tax shield, right? When on my income statement I report amortization, it reduces my income, and by reducing my income, it reduces the amount I need to pay in tax. Okay, and that tax shield is a real cash flow that is generated by my investment and by this amortization, by a accounting cash flow. Okay, so with different class, as I said, all here, right? These are the assets that go in each class. And you have different rate at which you can depreciate these assets. In an exam, you don't need to know these class by heart and which rate goes with them. You don't need to know which asset goes where. I'll just tell you it goes in an asset class that has a CCA rate of 20% or 10% or 50%. So you don't need to know any of this table by heart. It's just mostly here to help you with understanding what we're going to talk about right now. Okay, so just an example here. Suppose we undertake project A or project B. We've had project A and project B since the beginning of this chapter. They were both these projects. We pay $10,000 in investment, and then we get these cash flow out of A and these cash flows out of B. Okay, so imagine these two projects. Okay, imagine they're class 8 asset. Okay, so most machinery, radio, communication equipment, they are depreciable at a rate of 20%. Okay, so what would happen when we buy the asset in the first year? We would be able to report. We would increase this asset class by 10,000. Okay, in the first year of an investment, when we first spend money, right, to buy a new asset, we're not allowed to use the whole value for that year. The reason is pretty straightforward. Is it doesn't mean that we spent the money this year, that we spent it at the beginning of the year. So we shouldn't be allowed to use the whole value for the depreciation for the whole year. So the first year we are only allowed to depreciate the asset at half of its normal rate. That's where this 1/2 comes from. Okay, we have 10,000 in the pool. Here, assuming there was no assets before this in the pool, but even if there was, it doesn't really matter. The asset pool would only have went up by 10,000, right? So if we're analyzing the impact of this project only, it's only the 10,000 we care about. So there was 10,000 in the asset pool, and it depreciates at a rate of 20, so it will allow me to take a charge of $1,000 in amortization for this year. Okay, in the second year, I don't have the 1/2 anymore. That 1/2 is gone, right? There's no 1/2 because now the pool starts at 9,000, right? It started at 10,000 in year 1. I used 1,000 from it in year 1, so now I'm left with 9,000 in the CCA pool class 8. Okay, now that $9,000 will depreciate at a rate of 20%, so I'm going to be able to report 1,800 as depreciation for the year, or amortization for the year. Okay, my new undepreciated capital cost for this asset pool will be the 9,000, to which I minus 1,800. It's going to be 7,200. Next year I have 7,200. I can depreciate it at a rate of 20%. I'm going to get 1,440 that I can use as amortization for that year. Okay, I'm going to be left with 7,200 minus 1,440, 5,760 in undepreciated capital costs for this asset pool. Okay, does that make sense for everyone? And obviously this is going to go on forever because the depreciation rate is a percentage. In this case, it's not linear because it's 20% of the UCC. It's actually never going to go to zero. It will get really, really close to zero, but this would go on forever unless I sell the asset. But if I don't sell the asset and I just let it depreciate, this would basically generate a cash shield, a tax shield forever after. Okay, in the real world, we often end up selling the assets. Okay, so in this case, here what I'm doing is I suppose that I invested in both investment A and B. Okay, so I invested in both. My UCC class for asset pool 8, class 8, right, went up by 20,000. Okay, and then I've been depreciating it over the years, right? In year 3, I had 12,960 in undepreciated capital cost. Okay, and now in year 4, I decide to close the project. I decide to sell asset A and asset B. Okay, there's multiple scenarios that can happen given the sale of asset A and asset B. The first one is outcome 1. It would be valid as long as the value of the sale, so sale price for A, sale price for B, right, the value of both sale is lower than the undepreciated capital cost. In this case, if I sell asset A for 5,000, I sell asset B for 5,000, I have 2,960 that wasn't used from my undepreciated capital cost. So I can automatically just use that, right? Basically as a loss of capital. It's tax deductible, so I'm going to make 25% on this. I'm going to save 25% of this because I won't have to pay tax on this. Does that make sense? The other thing that could happen, outcome 2, is that I sell my 2 assets exactly at the price that the asset pool is. So I could sell the asset, one for 7,000, one for 5,960. That would give me 12,960, and I would have 0 left in my asset pool. In this case, I don't have any capital gain or capital loss. Okay, I could also sell my asset for more than my UCC. In this case, I would have to pay on a capital gain. I sold my asset for 2,040 more than the value of the asset as UCC, as reported by UCC, right? So I would make a capital gain of 2,040. I would have to pay 25% tax on this, so I would have to pay 510 in tax. Okay, I won't explain all of the details here. It's not actually really important because I'm actually not going to do a lot of this. Okay, the reality here is almost every time when I do make you analyze this capital cost allowance, I will almost always assume that the asset class is not empty, that there's other assets in that asset class, and if that's the case, there's never going to be termination or capital gain and so on and so forth. Okay, so you don't need to worry about it too much. Okay. You do need to worry, by the way, about this and this here. It's just closing the asset class, what I'm talking about in this slide, closing the asset class. I want you to understand the logic, the general logic, but you're definitely not, I'm definitely not going to make you do this all the time at all. I'm actually unlikely to even do it once in the exam, so the first part here is what I care about more. Okay, so I should probably call this differently. So what we care about here ultimately is that we want to find, right, the tax shield that is generated by the investment is a cash flow. So we want to find this cash flow, And it is a pretty hard cash flow to find, right? If we had the project here, this project here where we were investing in A and B, these numbers here are not even the numbers we want to report, right? Because our income went down by 1,000 because it was an amortization expense. So we got taxed on $1,000 less. This did not generate a cash flow of 1,000. It generated a cash flow of basically the tax shield. So just protected from the tax on $1,000, right? So 1,000 times the tax rate is the actual cash flow that we care about. 1,800 times the tax rate is the actual cash flow that we care about. So this is actually pretty complicated to calculate. It's really not that easy. So here what I did is I did an example. Suppose that we purchased a $30,000 van. Okay, we sell our current van for 500. And we have 52,000 in undepreciated capital costs in the asset pool for vans. Our tax rate is 25%, the discount rate is 12%, and the CCA rate, the rate at which we can depreciate this asset pool, is 30%. Okay, we will sell our vans in 4 years from now. What would be the PV of the tax shield generated by these whole transaction here? That's not even analyzing the whole project, because normally the project will also generate cash inflows, and we already know the cash outflows, right? It's going to be 30,000, but we're going to sell a van for 500. So we already know the cash outflows, but we don't know the cash inflows from the project. But we could calculate the tax shield, right? And then just the PV of that tax shield, the value today of that tax shield. Here's how we could do that. Okay, at the beginning of the year, I didn't say that earlier, but if you sell an asset, right, from an asset pool, it will go down. That class UCC will go down by that amount. So I bought a van for 30,000. I sold a van for 500. So basically, my asset class went up by 30,000 minus 5,000, so 29,500. Okay, in the first year, okay, if you're wondering what they're doing here, is we just care about the incremental cash flow. So they calculated by how much my asset pool went up, which is just 29,500, right? In the first year, I can only depreciate the asset pool at half the normal rate. So I put 1/2 here. I multiply by the increase in the asset pool times the depreciation rate. It means that in the first year I can depreciate this asset pool at or I can use $4,425 as amortization expense. Okay. In the next year, I have 29,500 minus 4,425 in UCC, that number here. And then I can depreciate that number at a rate of 30%. That's the amount I can use as amortization for this year. And then I can just keep going. I take 25,075 minus 7,523. I have this amount in my undepreciated capital costs. I can depreciate at a rate of 30%, blah, 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 blah. We can keep going. Does that make sense for everyone? Again, this is not even my tax shield, right? This is not even the tax shield. This is how much I can report in amortization, but I'm only going to save my tax times that amount, right? So what I was saying here is that we would need to multiply these numbers by 0.25. Then we would need to find their PVs, right? Discounted 1 year, 2 years, 3 years, and 4 years, depending where the cash flow happens, right? And by doing all, then we would do the sum of all of these, and we would find the PV of the tax shield. So that's a pretty demanding task. I have calculated it here for you, right? In this screen here, this was our amortization expense that we could use from this table here, right? This is 25% of the amortization expense because that's our tax shield. Was the tax rate 25%? Yeah, tax rate is 25%. So that's the amount basically of tax that we don't need to pay because we can use this as an expense, right? And then I discount it n years, where n is this number here, Okay, and then I sum all of these numbers here, which are all of my tax shield that I'm going to get over the years, and I get that the present value of my tax shield should be 4,579.1.01. Okay, this is a really annoying process. You do not want to do this most of the time in the class, so you actually just have to do this. Okay, this is always going to work if we don't close the asset class at the end of the project. This is the PV of the tax shield. I should probably write it like that. Oops. Okay, this is the PV of our tax shield. It's basically just this equation here. Okay. The R is our discount rate. TC is the corporate tax rate, the tax rate we have to pay. D is the depreciation rate of the CCA pool. Okay. CPV is the amount by which our UCC class pool goes up. In the previous case, that would have been the 29,500. Okay. SPV is the present value of the salvage value of the asset, this class pool. So basically this assumes that the asset pool will go up today and it will go down in the future because we're going to sell the asset for its salvage value. Just be really careful. The biggest place where students make mistake in using this equation is that this is the PV. Right? This is the PV of the salvage value. This is the PV of the purchase cost. That's usually that's not a problem for most students, this part here, because that's already the PV. Usually we have expenditure at the beginning of the project. But this one is usually problematic because a lot of students forget that you need to take the PV, not the final value. Okay? And yeah, I explain all of the variable in this equation. Do I want to explain more in detail where all these things come from? I don't know that it's super intuitive, so I won't explain all in detail what these things do. Just learn to use this equation here, and what it's going to do is it's going to find the PV of your tax shield here, right? All of the things in here. Yeah. Okay. It's going to give you a slightly different answers than mine that I got here if you use this equation, because when I did this here, I actually forgot to sell the asset in 4 years, so I kind of I shouldn't have used the 5 years, so I did it a little bit wrong. But basically the idea is we basically will just use this equation always to find the PV of the tax shield, and it's a lot easier. So using this example, how would we do that? Pretty straightforward. The asset class would go up by 29,500 at the beginning. The costs, right? The asset cost, the asset class pool will go up by 30,000 minus 500. The salvage value is $4,000. Oops, it's here too. Salvage value is $4,000, but I want to find the PV of that $4,000. So in here I would put the PV of $4,000 discounted at a rate of 12%. Okay, so just find the PV of $4,000 in 4 years, discounted at a rate of 12%, and you put that value in here. Okay, D would be the depreciation rate for the asset class pool, so 30%. DTC is our tax rate, so 25%. Okay, R is 12%, D is 30%, R is 12%, R is 12%. I put all these numbers in here, and then I calculate the answer, and I think I have the answer here. Did I do? Okay, I calculated the PV of the tax shield here, so I'll just go to the slide just now for a second. But if we wanted to calculate the PV of the tax shield, I told you we use 29,500 as the C. I'll just move that one up here a little bit as the C PV, right? Then I find the PV of $4,000 in 4 years from now at 12%. That should be 2,542. And then if you put all the other information I told you in for the last parenthesis, and you do the calculation, you should find that the PV of the tax shield in this case was 4,556. Does that make sense? Okay. This is not everything, right? Usually we don't just want to calculate the PV of the tax shield. Usually what we would want to do is analyze the whole project as a whole. So like just making this calculation is just one part of analyzing the project. What we would usually do is want to analyze if the project is a good project or a bad project. So I put a bit more information in this one. We have cash flows that are generated by this project. All the rest of the information is the same. I just added this sentence here. Okay, this sentence here just says that the cash inflows will go up by $33,000 per year, and the operating expense will go up by $16,000 per year. Okay, so if I wanted to analyze this project, the first thing I would have is I would have the present value of the tax shield, which is that 4,556 that we just calculated earlier. Okay, but what would be the cash flows of this project? We have year 0, year 1, year 2, year 3, and year 4. Well, we know that initially this project will cost us $30,000, right? But we will sell our old van for $500. So I'm going to have a cash outflow initially at time 0 of 30,000, and I'm going to have a cash inflow of 500. Okay. On top of it, we already calculated the PV of the tax shield. It's right here. So at time 0, I would also make a positive cash flow, which would be the PV of the tax shield for 4056. Okay, these would be all of my cash flows at time 0. Okay, but now at year 1, 2, 3, 4, I would get cash flows of 33,000 minus 16,000. So I would get 33, and I'll just write K here to save myself some times, and I would get cash outflow of 16K here. 33K here, 16K here, and these would happen every year after, so I'll just make little lines to say they happen every year after, so I don't have to repeat them. Okay, and then finally, the 33,000 minus the 16,000 will be taxed, right? Will be taxable. So I need to basically calculate this 33,000 minus the 16,000, and then I need to calculate 1 minus T of that, 1 minus the corporate tax rate of that, because some of it will be taxed. So what I would do is I can replace these two, right? What's 33,000? I can replace these two by 17,000. But this is a operating profit. This is a profit, right? Before tax. So I need to multiply all of them by 1 minus T, the tax rate. And I need to do this with all of these in every year. Okay, I already have this calculated in my slide here. I calculated it here. This would give me 12,750 in increased cash flow every year. Okay, from year 1 to year 4. The last cash flow we need to consider is at the end of the last year I will sell the assets that I purchased. I will sell it for $4,000. This will be a cash inflow at the end of the last year. So I'm going to have 4,000 here. Is that good? So if I wanted to analyze this decision, this is all the information I would do. Okay. This is if I wanted to find the NPV. We could do this for the IRR, but it would be a lot longer. Okay. If we wanted to find the NPV, we'll just write in another slide here. We can write the cash flows, right? They should be obvious because they were from the previous from the previous slide, what we just did here together, right? What I would put in is I would put CF0, right, would be this amount minus this amount. So 5,056 minus 30,000 is 24,000. I suck at mental math. I'll just do it on Excel. So that would be 24,944 negative. Sorry for using Excel, but my brain's not good at mental math from years of using calculators, unfortunately. Okay, then we want to find the cash flow in the first year. The cash flow in the first year, we have it here. It's 17,000 times 1 minus t, which we already calculated here to be 12,750. Okay, and that is our only cash flow for year 1, 2, and 3. It's also a cash flow in year 4, but in year 4 we will also sell the assets for 4,000. So I go here and I do 12,750 positive cash flow, and I do it for 3 years in a row. Okay, and then the last cash flow we have is in year 4. We have one cash flow. That cash flow will be 12,750 plus 4,000, so 16,750. And F02 will be 1. We go to I. We put in our interest rate, which was 12% here. 10% discount rate is 12%, and we compute NPV, and we get our answer. I'll just stop the recording as I calculate this. And we should get the answer, which was already here all along, 16,324. Okay, I make sure just to do all of these with you to make sure that I don't say anything silly. Sometimes I do make little mistakes, so I just calculate it at the end to verify I didn't make any mistakes. 16,324 is our PV. Okay, so this is a pretty big question. This is questions you'll have to do definitely in the exam. I don't really know how I'm going to do them at this point because I don't know that it's going to be really easy to do this on D2L with like algorithmic question where the numbers change easily. I don't know if I'll be able to do all of that on D2L, so I don't know how this is going to work yet for your exam. Hopefully I can tell you more information tomorrow. Okay, I want to change a little bit the way I'm going to move forward and do practice question. Okay, I just stopped the video because I stopped here and I'm not too sure what I want to say. I have these two examples. Normally in class I would make you do them in class. I proposed to my Business 230 class to gather once a week to do these problems together. So I don't know if you would prefer that. The class average was really high for this class, and you've been doing pretty good. So I don't know if you would enjoy that, or if you prefer I keep doing it as a recording. So tonight is my check-in with you guys. So I will check in with you guys tonight, and I'll see. Maybe I'll just post an extra video where I do the solution for these two, depending on the feedback I get tonight for the check-in. Okay. So for now, I won't do these. Either I'm going to do them Tuesday the 2nd, or I'm going to do them tomorrow and I'm going to post them as a video, depending on how the check-in goes tonight and what people tell me, if they would prefer we do that together Tuesday night, not for the whole time, but like we could join together for 30 minutes or 45 minutes. It's going to give you some time to ask me question, and then I can go over the solution. But I'll post a news item tomorrow talking about these two questions, so I don't know what's going to happen with them for now. Sorry for losing 2 minutes talking about that. Okay. This is just a general and quicker question, an example, so I'll just do it now. But before doing that, I just want to talk about the MIRR. Okay, it's the modified IRR. It basically deals with one of the three problems of the IRR. One of the second problem I had, if you go back in my list of problems with the IRR, is that the IRR assumes that we can reinvest our cash flows at the same rate as the IRR, and that's not really um, true or possible in the real world usually, especially if the IRR is really high. Okay, to compute the MIRR, we basically do the same thing we would do to calculate the IRR. So it's calculating the IRR, but before we calculate the IRR, we're going to move all of our cash flows, right? All of the cash inflow from the project at the end date of the project. So imagine you have a project, right? And that project costs, I don't know, $30,000 initially, and it generates $15,000 per year for 4 years. What we would do is we would take these three 15,000 and we would move them here, find their FV by using annuities, right? And the interest rate we would use to move these 15,000 forward would be our cost of capital. Basically what the IRR does, it assumes that we can move these cash flow forward at the IRR as a rate of return. Okay, a better rate of return to use to assume as our normal rate of return that we can generate is the cost of capital. So instead of using the IRR to move them forward, what we do is we take all of these cash flows, we'll move them forward, find their FV by using our cost of capital as the interest rate. Okay, and once we've done that, we moved all these cash flow here. We're going to compute the IRR of this project with the FV here, the 15,000 here, and the 30,000 as our initial project. And by calculating the IRR of this project, we effectively calculated the MIRR. Okay, it's really not that hard to do. I'm pretty sure I have an example right after the slide after. So we're going to do that. You'll see it's really not that hard to do. A lot of students mess it up in the exam because they go a bit too fast over this material and they didn't make enough practice. So make sure you do a couple of practice questions to make sure you understand what to do. But it's definitely not the most complicated part of this chapter, hopefully. Okay, so I have the examples here. Okay, we have a project that will cost $100,000. It will generate $25,000 in cash flow from year 1 to 4, $20,000 in year 5 to 10. The weighted average cost of capital for the company is 8.3%. Okay, find the NPV, the IRR, and the MIRR. Let's do this now. So I'm going to give you a little bit of time. You should be able to do the NPV and IRR easily. Maybe you'll struggle a bit more with the MIRR, but it will allow me to do an example. So here I wrote all of the cash flows you should have had, right, in order to find the NPV for this project. Okay, just calculate the NPV at an interest rate of 8.43%. And if you get that, you should get the answer, 48,855.13. Okay, to find the IRR, it's basically the same idea. You leave all of your cash flows in, you just go to IRR and you hit compute. Okay, and you should get that the IRR is 18.99%. Okay, for doing the MIRR, that's a little bit more complicated, is what I said earlier, but it's not that bad. If you were successful and you were able to do, well, maybe I have a couple too many of these here. And if you were able to do the material from chapter 9, hopefully you'll be able to do it pretty straightforwardly, hopefully. Okay, so what we want to do, right, in this specific case, if I make my timeline here, okay, we have time 0, we have time 1, all the way to time 4, we have time 5, all the way to time 10. Okay, initially I get a cash outflow of $100,000 negative. Okay, basically then I have 25,000 here all the way to year 4, and I have 20,000 at year 5 all the way to year 10. What I want to do is I want to move all of these cash flow to year 10, to period 10. So what I'm going to do is I'm going to use annuity to find the FV of these 4 payments of 25,000, and then I'm going to use that FV and the 6th payment of 20,000 to find the FV of all these payments at year 10. The important thing here, this part should be easy. I think you guys all did well in chapter 9 pretty much, so that part shouldn't be too complicated. What we want to do here, the interest rate we want to use, is we want to use the cost of capital 8.3, because when we're doing the IRR, basically the IRR is assuming that we're reinvesting these cash flows at basically 19%. But our cost of capital is 8.3, which means that usually the rate of return we're able to get on investment is 8.3, not 18.99. So it's nice. This is a really great project if we're able to make a higher rate of return on it, but it's assuming that we're able to reinvest all of these cash flows at 25,000 here at basically 19%, which we usually can't. Usually we can only get 8.3%. Okay, so let's do this. For this one, I will leave everything. I will record everything I'm doing because I want to talk about it as I'm typing it. So the first one is moving the 25K to year 4. Right, that's the first thing we want to do. Okay, in order to do that, I have 4 periods. Right, the interest rate. What am I doing? Okay, the interest that I want to use is 8.3%. Okay, I don't have any PVs. Oh well, let's do P over Y and C over Y. The payments per year and the compounding periods per year. In these chapters, we'll basically always be using just one. Right, I don't state it in the question, but it's just implied that we just use one. There's no PV. There's no numbers at the beginning here. Right, so there's no PVs. The payments are 25,000, and we want to compute our FV. Okay, does that make sense for everyone? So I'll just calculate that on my calculator, and we should get that the FV will be 113,153 and 19 cents. Okay, now what I want to do is I want to take this FV, I want to take this 113,000 and the 20,000 and move it to year 10. Okay, so that's what I'm going to do here, moving the 113K and 20K to year 10. Okay, I'm going to do it directly on Excel by explaining what I'm doing as we go along, because we can do that on Excel. Equal FV, right? We want to calculate the FV at an interest rate of 0.83%, so at 8.3%. The number of periods that we want to use is 6, so that would be my N in the calculator. The 0.083 would be my I over Y. The payment is $20,000. The PV is 113,153.19. Okay, and we want an end of period annuity. We don't want an annuity due, so we put 0 here and we calculate the answer. Okay, so 330,406, and now I'll just write all the information I just gave you. N is 6, I over Y is 8.3, P over Y and C over Y are both 1. My PV is 113,153.19. My payment is 20,000, and I compute the FV. And for those of you who doubt me, I will now do it on the calculator to show you that it's the same. I'll just stop, pause it, and I get 330,406.33, which is the same thing I got by using Excel. Okay, we're not done. Okay, remember when we calculate the MIRR, I want to move everything here, and then I want to calculate the IRR of this project. Okay, by having moved all of these cash flows to the future at my cost of capital, I will have removed the problem from the IRR, that I basically assume that we're moving all the cash flow forward at the IRR at that rate. We actually here move them all forward at 8.3, so I'm going to have reduce or remove that problem completely. So calculating the IRR of this project is the next step we need to do. CF0 will be $100,000 negative. Okay, the C01 will be $0, right? And we will have 9 of these $0, because remember we moved all of our cash flows to the last year, to year 10. So then I have $0 times 9 times in a row. My last cash flow at year 10 will be $330,406.33. Okay, and that cash flow arrives once. Sorry, F02 is 1. And then I compute the IRR for that project, and I will call that the MIRR. Okay, does that make sense for everyone? I'll just calculate it. And we get that the answer should be 12.70. Oops, that didn't write. 12.70. Okay, percent. Now here's the reason I want to repeat this, because I know theoretical points don't always stick for you. Okay, theoretically the MIRR is better than the IRR. Practically it changed nothing at all. Based on the IRR, would you recommend doing this project? Right, I only calculated the numbers here. I didn't actually answer the question. Right? We should actually answer the question. But based on the IRR, would you do this project? Yes, you should. Right? Yes, because since IRR is bigger than the cost of capital. Right? The MIRR is the same decision rule. We should do the project, yes, since MIRR is bigger than the cost of capital. Here's the thing though, if the IRR is bigger than the cost of capital, the MIRR is always also going to be higher than the cost of capital. Okay, so practically in the real world, most people just use the IRR because it's always going to give us the same answer as the MIRR. And I don't know if you can look at this here, the amount of work we did, okay, and you can look at the amount of work we did to get the IRR here. It's a lot easier to do the IRR. So since practically they give us the same answer, even though the MIRR is theoretically superior, it doesn't really matter. Most people will just use the IRR. Okay, we should also do the project based on the NPV because the NPV is bigger than 0. Okay, so that's the end of this chapter. I skipped 3 questions. I know one of them I said I wouldn't skip. I skipped this one. Basically I skipped these 3, 36, 37, 38. Okay, I will ask tonight if you want me to do these questions with you live in the class on Tuesday, so starting at 6. It's going to take 30 minutes to 1 hour. Just do them there live so that I can answer some of your questions. If I get the feedback tonight that no one wants to do that and no one will show up, I won't do that. I'll just record the answers tomorrow and post them as a video. Otherwise, I will either just post a solution and slide, or I will try, but I don't know yet how to do it, so I don't know if it's going to work for the first time I try, but I will try to record the session on Tuesday if I have lots of students, and then you can listen to that session later on. Okay, so that's it for me right now. That's for chapter 12. We're done, and that's all I wanted to cover for this week, because I think I'm at an hour 90 minutes, an hour and a half. Well, that's a bit quick, but with the with these 3 questions that we're going to do, it should get us to a good amount of time. Also, your exam's coming up, so the next section will be relatively short. I don't want to do too much because I don't want to overwhelm you just the half week before the exam. Okay, so good luck, and I'll tell you what happens with these 3 questions if I just post a solution, if I do a video with a solution, or if we do them live on Tuesday tomorrow morning once I've had time to talk with everyone.